My portfolio crashed, losing 40% in weeks. It wasn't properly diversified. I'll show you how to build a truly diversified portfolio and avoid the same mistake. You could save thousands of dollars with this one lesson. It's easier than you think. We'll start with the basics. Why does diversification matter so much? Think of your portfolio as a basket and each investment as an egg. If all your eggs are in one basket and that basket drops, you lose everything. The first thing you need to know is this: putting all your money into one stock, one sector, or even one asset class is a risky move. It's like betting everything on one horse. Sure, it could win, but what if it doesn't? Let me share a quick story about myself. When I first started investing, I was really excited about tech and put most of my money into a popular tech company. I was confident, thinking, what could go wrong? Tech is the future. But then the tech market dipped, and I lost nearly 40% of my portfolio's value in just a few weeks. If I had diversified and spread my investments across other sectors like healthcare, consumer staples, or even real estate, the losses wouldn't have hit me so hard. That experience taught me that diversification isn't just a strategy, it's protection. So, how do you actually build a diversified portfolio? There's only 4 steps. 1. Stocks. Think of stocks as buying tiny pieces of big companies. For example, you can buy a stock in a company like Apple or Amazon. A great tool to help with this is an index fund like the S&P 500, which spreads your money across 500 different companies. This way, you're not just depending on one company to do well. 2. Bonds. Bonds are like giving a loan to a company or the government. Imagine if you lend your allowance to a friend and they promise to pay you back with a little extra. Bonds are safer than stocks because they don't change much in value. Tools like treasury bonds or corporate bonds are good examples. They help keep your money safe when the stock market is going up and down a lot. 3. Real estate. You don't need to buy a house to invest in real estate. Instead, you can buy shares in real estate investment trusts, which are companies that own buildings and rental properties. For instance, the Vanguard Real Estate ETF invests in many different properties, so you can earn money from real estate without managing it yourself. 4. Alternative investments. Consider adding some savings bonds or peer-to-peer lending to your portfolio. Savings bonds are a low-risk option where you lend money to the government and they pay you back with interest after a set time. They provide steady, reliable returns and add stability to your investments. Peer-to-peer lending lets you lend money directly to individuals or small businesses through online platforms. You earn interest as they repay you, though this option carries more risk because there's a chance the borrower might not pay back. To keep your portfolio balanced, only allocate about 5 to 10% of your investments to these alternatives. Before I let you know about that big mistake, for those who want to take their portfolio to the next level, here are 3 extra tips. Invest in other countries. Instead of only investing in US companies, you can buy stocks from other countries. Tools like Vanguard Total International Stock ETF let you invest in companies from all over the world, so you're not just relying on the US economy. Invest regularly. Instead of putting all your money in at once, add a little bit every month. This is called dollar cost averaging. It helps you buy more shares when prices are low and fewer when prices are high, so you don't lose too much if the market drops suddenly. Check your mix. Look at your investments every few months to make sure you still have a good mix. You can use tools like Personal Capital to see if your stocks, bonds, and other investments are balanced and adjust if needed. Now, let's talk about that big mistake, sector concentration. Many investors think they're diversified because they own multiple stocks. But if those stocks are all in the same sector, like tech or energy, you're still at risk if that sector takes a hit. True diversification means spreading your investments across different sectors and asset classes, like stocks, bonds, real estate, and commodities. It's also important to have some exposure to international markets. That way, you're not just betting on one country's economy. Now, a common question is, how much should I allocate to each asset? This really depends on your age, risk tolerance, and financial goals. Younger investors can afford to take on more risk because they have time to recover from market drops. Older investors might want to be more conservative. A good rule of thumb is to use your age to determine your bond allocation. If you're 30, you might want 30% in bonds and 70% in stocks. For a 60-year-old, the opposite might make sense. Let me tell you about how I got better at investing. I used to rely on a simple spreadsheet to track my stocks and bonds. At first, it felt organized, but soon things got messy. For instance, stocks that were meant to be 40% of my portfolio surged to 60%, and I was overwhelmed trying to keep up. I started using Betterment. It made managing my investments easier by providing a clear visual of my portfolio and automatically rebalancing it. This took a lot of the stress out of tracking my investments. Next, I turned to Yahoo Finance to dig deeper into my holdings. I discovered that I was too heavily invested in tech stocks like Apple and Microsoft. Yahoo Finance helped me see the need to diversify into other areas, such as healthcare and utilities. I also began using Mint to get a complete view of my finances. It brought all my accounts together, which helped me track my spending and savings more effectively. Another smart addition to your diversification strategy is investing in top-notch ETFs. The video showing up on the screen is about the 6 best ETFs to buy and hold forever. It's packed with practical advice to help you enhance your investment approach. The tools and resources mentioned in this video are linked below. I'll see you in the next video.